Okay, so I'll be recording this as well as going live on Facebook. So it is 7:02, and I'm going to start us off. So I'm sure people will be coming in as we go, but I like to respect the people that have shown up on time. So thank you for showing up, everyone. This is my first webinar that I'm hosting. And what I'd like to talk about first is I'd like to encourage you guys to be interactive. So if you have any questions during the presentation, either unmute yourselves and speak. And if you're not speaking, just please unmute yourselves so we can not have too many distractions. And if you don't want to just interrupt by speaking, go on the chat button, which is on the bottom of the screen. If you hover down there with your little mouse, you'll see a chat button. Just push that, and then you can type in your question, and we'll get to it. So that's how I encourage you to be interactive. The speakers are aware that you guys want to be interactive. So again, it's going to be interactive. And it is live, and we are recording. So there will be a copy of this afterwards if you want to watch it again. So first, I'd like to introduce the speakers. The first speaker we have is Niall Kirby. Niall is the District Vice President of RBC Global Asset Management, and he's working as an investment professional of the firm to provide market updates and consultation for building resilient portfolios with investment advisors. He is a CFA Charterholder and Economics graduate from Queen's University with over a decade in the finance industry. So Niall is also, from my understanding, the spokesperson for RBC's economist. He's a wealth of knowledge. He's got a great deal of experience, and I've had the privilege to see him speak a number of times, and the information that he provides is very valuable. So I hope you find it valuable as well. Our second speaker will be Victor Turcan. He's an investment advisor and financial planner with RBC Dominion Securities, managing his clients through the comprehensive financial planning and investment management wealth protection disciplines to deliver tailored strategies designed to satisfy clients' short-term and long-term needs. He has over 15 years of experience in the finance industry, holding a number of industry designations, including Chartered Investment Manager and Certified Financial Planner. Victor has an MBA in Finance and Banking and a BA in Economics and Bachelor of Science in Computer Science. And your third speaker, I'll be speaking a little bit about the real estate market from a little bit of a macro level, but more of street level, as I've been in the trenches and on the streets and what I'm seeing in the market as well. So we'll jump right into the presentation, and I'll ask Niall to start his presentation.
Great, yeah, thanks, Andre, for the introduction. It sounds like everyone can see me and hear me and see my slides. I'll be referencing them. Thanks for your time. We're getting people dialing in across the country. It's incredible. So really appreciate it. I love this topic. I love talking about the economy and markets. So by all means, if there's questions, please, yeah, I'd be happy to kind of talk about a topic a little bit further. Since, yeah, we're all in this kind of new working environment. I've got a toddler downstairs. If you hear pots and pans, no one's cooking. That's his toy. Like, expensive toys are not needed in this house. It's pots and pans for our guy. But yeah, it's kind of fun to do something different at night. So I'm just going to get started and talk a little bit about what we see at RBC Global Asset Management. So like Andre said, I get to talk and hear conference calls and meet with the smartest people at our firm, our portfolio management team, our chief economists, get what they are seeing, what they're hearing in the markets when they talk to CEOs of major companies we all know and use their products every day, and what their outlook is going forward. And it's not a better time than today, with just this incredible change in the market.
So it is
We've
very
seen
chaotic up there.
So I'm going to start here with what we've seen. And right now, it's really just a roller coaster in the equity market. This goes back only 2 years, this chart, but I think this is all you really need to see with in 2019 was a pretty strong year, all things considered. And then look how fast things change in 2020. So everyone's obviously very aware of what's happening. They've been watching the news. Some anecdotal stuff we've seen. One of our smartest people in the firm, in my opinion, she's the smartest person we have managing investments. Her name is Dagmara Fajolkowski. She runs all of our fixed income, all of our currency. She saw something in March she's never seen in her 30-year career. She buys and sells bonds, and the US Treasury, that is the most liquid, safest bond out there. And there was one day in March, there was no buyers. Liquidity dried up. So what that means, when the liquidity dries up, there's no buyers and sellers exchanging. People were panicked on some of those days in March and just said, not only do I want to just get out of the markets and go to cash, but I'm just going to be on the sidelines. And then that's typically what you see when liquidity gets that crazy. An event like that happen, that's just really the hallmark of panic selling. So that's what happened. You can see here in this chart, late February, early March, and it was about March 23rd. That was when markets bottomed. And you see here that arrow going up. There's been a bit of a rebound lately. There's a couple reasons for that. I'm going to get into that in a few slides, but it's incredible how fast things happen. Trying to time the markets is just impossible. Warren Buffett, one of the smartest investors of our lifetimes, he doesn't believe anyone can time the markets. And this rapid roller coaster is a good example of that. But this is the reason why we saw that sell-off, right? It's COVID-19, not just occurring in China, but now getting out to the rest of the world. And what we look at here with this dark blue line is the transmission rate in the world. So by transmission rate, that means for every one person that catches the virus, how many other likely people are they to infect? And you can see in the middle, it peaked just over 3. That was mid-March. For every one person that caught COVID-19, they were likely to pass it on to 3 more people. Obviously, when you have any number above 1, it's a growing trend, right? Because it's going to be just rapidly accelerating. The magic number, of course, is 1, because once you get it below that level, then it will peter itself out. We won't be going in a higher growth trajectory. We will start to see a decline. The last few days, actually, some positives. Countries like Spain, countries like Italy, really showing some signs of leveling off. And it's too early to make a call on Canada yet, but there have been some positive data coming in from Canada, especially places like British Columbia. That province is having a better experience. But this is what markets are reacting to, right? Markets react as a forward pricing mechanism. So they discount future growth. That means if there's a recession coming down the road, stock markets will sell off and fall before that happens. They react and they see that danger coming down the road. That's why we saw in that first slide, markets just absolutely collapsed, knowing that a recession's coming. So there's no doubt we are going to be in a recession. And this is a good way of explaining it. Look at this chart. This is incredible. So this is the US jobless claims skyrocketed. If you didn't see this chart, you might just think that final bar on the right is just where the chart ends, is the border. No, like that is actually what happened the week ending March 28th. So jobless claims, this is every Tuesday, Americans out of work going to the Department of Labor office and filing for unemployment. And you'll see here in past periods, it accelerated in the early 90s. That's that gray bar there. That's the recession of the early 90s. They called it the savings and loans crisis. Then you see after the year 2000, that was the tech wreck, like the tech bubble. And coincided with 9/11. It was a really terrible time for investors. Of course, 2008. So that one's a little bit more relevant to people's minds. It was the last true recession. It was a little bit slower for jobless claims to go higher. They certainly did. This happened incredibly fast. So that's probably the one thing to take away about our analysis of this recession. It's going to be very front loaded. The pain is going to be felt very fast and severe at the very, very beginning, because this is a government mandated shutdown of the economy. It's not simply like a 2008 when there was a bubble and the economy burst like it often does in business cycles. This was something entirely different, shut down by the economy, by the government, I should say. So this next slide, I'm going to compare COVID-19 to the global financial crisis. That's 2008 in the middle. And there's the Great Depression on the far right. That's 1929 leading into the 30s, the dirty 30s. So a lot of people are wondering, is this current recession going to turn into a depression? So this is what our chief economist, Eric Lascelles, has been analyzing. So for the COVID-19 predictions, he's using a medium depth, medium length scenario. So he's not just going with a conservative analysis scenario saying this is going to be very minor. He's actually putting some serious concerns into our base case here. But basically a 12-week economic shutdown is his base case. We're only on week 5 right now. So he's certainly putting in some caution and some conservative estimates, not just trying to cut corners. And if you look here on these rows, the first one, quarter over quarter decline. Yeah, worse than 2008. Front loaded this recession. The pain is very severe right at the beginning. We don't have that data for Great Depression, but let's go to the next one. Year over year decline. Again, COVID-19, much more severe right away than the global financial crisis, but less severe than the Great Depression. We don't think this is going to be that bad as the Great Depression of 1929 into the 30s. Whether that's that one row, let's go to the next one, the peak to trough decline, not as bad as the dirty 30s. And then finally, this last row, this is the cumulative foregone output. So this is measuring all the output we lose from our economy, our GDP, and the time it takes to get back over this entire period, however long it stretches, to where we should have been. The global financial crisis was painful, nothing like the Great Depression. Like that was an entire decade of the 1930s that output, it took so long to get back to where it should have been. It was World War II that actually got the economy going again in 1939 for finally that depression to end. The war machine obviously needed women to join the workforce. There was a huge demand for manufacturing. That's what ended the Great Depression. But look at all that pain it took to get there. We actually think the COVID-19 crisis won't be as bad as even 2008. 2008, that financial crisis took about 11 years for us to finally get back to the trajectory we were on. It was a very long, painful recovery because some of the damage that was done was long lasting. There were scars in the economy for many years. We don't think it's going to be that way here because just like the government can shut down the economy, it's easier to rapidly turn it back on. Spain, factories are back running again now. Manufacturing is running in Spain again. Similar things are happening in France and Germany, Sweden and Denmark too. Denmark now, Danish kids are going back to school next week. So there's been changes across the globe here in 2020 that we just think it's going to be a shorter period, about 2 years, to get back to our output compared to 11 just in 2008. So definitely not as severe as the Great Depression, certainly shorter than 2008. And part of the reason is this slide. So there's a lot of numbers on here. I would think the one to look at is first the column of all the countries. Australia and Canada at the top. US is further down below. that policy rate cut, that's just central banks cutting rates. Like Stephen Polo's, everyone probably knows here, he's cut rates. If you're on a variable rate mortgage, you're seeing it already. Your variable rate mortgage is at bottom levels these days. So governments have done that to make sure it's easy to borrow money and invest. They want to make sure lending is fluid. The next one, that's asset purchases. Again, that's Stephen Polo's and other central banks like the US Fed going into the markets, providing liquidity. That crazy anecdote I shared at the very start of this call, that sort of issue of illiquidity has now been taken out. That's been fixed by all these asset purchases here by central banks. And then the right half of this chart, under the green, that's the fiscal and relief stimulus. Americans are receiving checks in the mail. Canadians, we have relief packages. There are all sorts of fiscal stimulus happening right now. This definitely didn't occur in 1929. If anything, the incredible policy moves that all the Fed and Bank of Canada and other central banks have done now, that was because they looked at history. A lot of people think that the 1929 recession turned into a depression because of policy errors, by mistakes of central banks then. That has been burned into central banks' memories and policy guidelines for decades ever since, to avoid the same mistakes that were made in 1929. So that's why we don't think it's going to be anywhere severe like then. To compare it just to now 2008, things have happened far quicker this time. The central bank rate cuts have happened far quicker. And also the stimulus, the relief packages, they're 11 times larger now than 2008. So it's overwhelming. Like, it's a shock and awe approach. So much stimulus all at the same time, coordinated across the globe, 11 times larger than 08. That's why you saw stocks rally the last few weeks. Now this next chart here, to see, is this going to be a sustained rally? Like, is this just a quick bounce higher before it goes a little bit lower? That's what some people always wonder. Again, no one can time it. But things that we're looking for at RBC that will give us confidence that this is a longer term rally and recovery is here. There's a criteria, and have we achieved it yet? We've achieved the first three mostly. We've done containment efforts. There's government stimulus. In Italy, which was that test case, canary in the coal mine for the rest of the developed world, shown massive improvements. If you look at these next few, however, this market is not going to fully recover until this group of criteria in the middle starts to improve. So that's decline in US cases. United States is still the world's largest economy. Decline in global new cases. They're the majority of cases there. The bottom few criterias, things like, do we finally leave this recession and now we're back in growth? Is there finally a vaccine? Markets will bounce back before those happen. Those are called lagging indicators, which means you will finally get that check mark far after your stocks have rebounded. Because again, equities are forward pricing. They discount future growth. They will react far quicker than it takes for these things to be ready and clear and available for anyone to see. So before I go on to that, any questions? There was a lot of data there in the last couple slides. I want to just quickly stop, give a pause if anyone does have a question. If not, I can continue, no problem.
If anyone has a question, you can either enter it into the chat room or you can unmute yourself and ask Neil anything you want.
Okay. Well, we got time, definitely. I'm going to be here afterwards. We'll now go into a bit of the bad news. This is what epidemiologists are looking for, right? A resurgence. You've seen this in Singapore. Singapore 2 weeks ago opened up the restaurants and bars again. They've now shut them down after a small resurgence. So this is obviously what's keeping epidemiologists up at night. this is the 1918 Spanish flu experience in England and Wales. That's some of the best data available that we have to analyze. A bit of a resurgence you can see, and it's very seasonal, coming back in the colder months. Now, the good news for today is that this is measuring deaths per 1,000 persons that are far higher than COVID-19. COVID-19 is nowhere near the severity as the 1918 Spanish flu was. So that's what's giving us cause for optimism, as well as just better technology, hygiene standards, other 21st century medicine that we have available today would be the second part. But certainly this is something people are looking for and that we're watching too when it comes to the impact this will have on markets and the economy. Now, kind of bringing it closer to home, our economy. Now, we are going to have a tougher go. We're getting this double whammy effect of not just the virus shutdown, but the oil shock. So Alberta has been in recession for a little while before this. Alberta's having the worst job losses right now in March and April because of that dependency on oil. The reason why this shock happened, and it was at the worst possible time that Russia and Saudi Arabia decided to butt heads. So they're part of that cartel called OPEC, where they want to sort of have the price of barrel of an oil at a certain amount that meets their needs. And Saudi and Russia just didn't play ball. And because of that, Saudi just decided we were going to take market share from you, Russia, and we're just going to cut our prices. We're just going to flood the market with supply. We're just going to try to wait you out, Russia. And what does that do for the global price of oil? That comes shattering low, and that affects Alberta. So that's a big reason why, not just Alberta, but also Saskatchewan too. They've got a big commodity economy as well. That's why the recession is going to be very tough in provinces like that. You're already seeing unemployment numbers higher in Canada, and they're certainly higher in those two provinces in the prairies. And then, of course, the same effect that's happening to Europe, that's happening to US on the economic shutdown. So one reason why Canada is going to be a little bit tough as an economy, and that's going to filter into our housing market. So a couple quick high-level points I'll give here. You'll see here at February and early March, these arrows were all pointing upwards. Things like housing starts, household credit, house prices, home sales, they've all now turned down. All except mostly for house prices, actually. They have been relatively stable. I'll quickly show the high-level macro view why that is, we think, is that yes, there is less demand for homes. For people are far less likely to go to an open house with 100 other people and look at home properties to buy. But also, with less demand, there's less supply too today. Many people are waiting this out. So we see this likely happening kind of from a macro view that there will be lesser transactions, but as far as the prices of homes, particularly in the GTA, we see that actually being somewhat stable. But that's just our top level view. Like I'll pass maybe on to Andre now to give us a little bit more of the what you see in the field.
Thanks, Neil. So with regards to the real estate market, what you said is very accurate, and there hasn't been much drastic changes in the real estate prices. There's been a freeze, and it's not like it's been a gradual decline from a start of a recession like 2008, but this has just been a dead freeze. Some statistics that I'll share with you guys is the number of I guess more of a micro level, the number of showings, offers, solds, how many listings there are, how they've been impacted from exactly 1 month ago. I'll give you statistics that are from the second week of March and how they compare to the second week of April. So this is from statistics from a program called Broker Bay, or a company named Broker Bay. They handle approximately 50% of the brokerages out there with regards to appointments booked, offers registered, and handling their listings as well. So showings have decreased 80% month over month. So the second week of March, again, to the second week of April, showings booked, 80% decrease. The amount of registered offers have decreased by 87%. The number of new MLS listings uploaded onto MLS has been down by 60%. The number of new exclusive listings have been down by 49%. And the number of solds have been down by 70%. So there's obviously a drastic decline. But the good news is that they've sort of leveled off. Like we've gone up in the second week of March, and then all of a sudden it went down. So now we're kind of like on a plateau, if you want to call it that. So it seems like these buyers and sellers that are out there right now are the ones that either need to sell or need to buy. And no doubt there are those bargain hunters out there as well. But that's what we're dealing with right now. So what's going to happen after this sort of plateau? Will it start to uptick, or will it just level off and stay, or will it go down again? That's to be determined, and that will ultimately be determined by how things progress. But regarding pricing, I have not seen many drastic price decreases out there. There have been a couple of surprises, like if you are holding back offers to create a bidding war, you're not going to see a whole lot of that right now. It's more people are pricing houses market value and expecting to get close and around there, or they're ready to negotiate with you, versus pricing it low and hoping for a bidding war. But because interest rates have gone down, that will, I believe, stir up the real estate market again once things normalize a little bit. It's like real estate will be the first ones out of the gate. And this will help the real estate market as well. Immigration, Canada roughly gets about 450,000 immigrants a year. That has come to us a dead stop because the borders have been closed. So this will impact the rental demand, because most of these immigrants do end up renting. So that will lower the rental demand, and combine that with the issues that probably Airbnb or short-term rentals will have, because not many people are going into these places to stay, or the hotels. So those shorter-term rentals will now likely become longer-term rentals. So the supply of the rental market will probably increase, coupled with the rental demand decrease. So I can see prices maybe adjusting on the rental market. As for the end game, again, I know I talked to many of you guys about this before. The vaccine is probably the end game here. And when will that happen? Well, back to normal for real estate or multifamily investing, I can see this happening in about a year or two from now. That's a real rough estimate, but it really comes down to when this vaccine will be created. My personal advice to certain clients when it comes to selling, obviously it does go case by case scenario, but for the most part, it has been, if you can hold on, hold on. Do whatever you can to not have to go on the market right now. But if you have to, then we will deal with it. We have the means to deal with it. We have the technology to deal with it. We have the expertise and the protocols now in place to take care of your listings. As for buyers, majority of the buyers have been put on hold. And that's not necessarily a piece of advice that I'm offering, but if you were to ask me, would I go on hold right now? Very likely. And the simple reason is because I don't know what's going to happen in 2-3 months from now. Will there be a better buying opportunity then? But again, if I have to buy right now, then I'm going to do the best I can by doing that. So that's my little tidbit on the real estate market. Anyone have questions on that? Feel free to unmute yourselves. throw a question in the chat box, or I'll pass it back to Neil. All right, go ahead.
Okay, perfect. Okay, so just, yeah, a couple more slides now on maintaining perspective and putting this into context. So we've seen this wild run lately, but in the course of history, where does this sit? So a lot of people here might remember December 2 years ago, 2018, in particular Christmas Eve. The markets were having a really rough December, and they troughed, they bottomed on Christmas Eve of 2018. We're actually a little bit higher than there right now, despite all this bad pain we've seen in February and March. Putting it just in perspective over just this little short period, we're higher than we were Christmas Eve 2018. But no doubt we are in a bear market. So the technical definition of what is a bear market, it's when stocks fall 20%. So from its peak down, once you hit 20% down, you're now officially in a bear market. They happen roughly every 7 years. Sometimes they're incredibly painful, but they're always very short in magnitude. They are definitely severe, and they're painful when they occur, but they're short and they pale in comparison to just the magnitude and the length of the bull markets, of the gains that happen after these periods of pain. Today, we're at a negative 33.9% at its worst peak to trough. Impossible to time if it's going to go lower than that, but certainly over the course of history, one of the worst ones already. We've already passed that average amount. So a lot of people ask, okay, after stocks have fallen so much, is this a good time to buy? So let's look here, going back to 6 major recessions, and if someone bought into the stock market after it fell 25%, you were in bear market territory and then some, and you decided to put money to work and buy into stocks. Well, your average 1 year out return was 19% over the all 6. If you look at the 3, 5, 10-year column, now that's giving you average annual returns since that period. Those are just incredible. So if you look at a 10-year return averaging 10%, you're more than doubling your money. You're having that miracle of compounding growth. Only one period, 2008, had a negative 1 year return, but its 10-year number is the second highest on this list. So bear markets, historically for investors, have just been an incredible opportunity to buy, and people have been rewarded. Even though bear markets feel very painful at the time, you often make most of your money during bear markets, even if it doesn't feel like it. For the ones that are slowly buying into the market, it doesn't have to be all at once, but if you can just be disciplined a little bit, consistently, whether that's monthly, that has rewarded investors whenever stocks fall this far. Because it's funny how whenever there's a sale at the stores, people will go running to buy products on sales at the shops, but when there's a sale in the markets, people will completely avoid it. And that's what this next slide shows. Even if you're not going to buy in to the market, avoiding selling out and going into cash, like that panic move, is probably the #1 thing to take home here. This dark blue line, that's the stock market. That's the TSX, Toronto Stock Exchange. And then these gray bars here, those are equity fund flows. So when the gray bars go up, that is people buying into the stock market. And when they go down, that's people pulling out and going to cash. And if you look at these giant red squares here in the bottom, whether it's 2003, right after that tech wreck, it's that major red square in the middle I want to focus on here. Right after 08 and 09, people were just pulling out of stocks at the worst possible time. This was a long 12-year bull market, a long 12-year growth period, but a lot of people didn't participate with it at all because they sold at the worst possible time. And that goes just back to being human beings, right? Behavioral finance and human psychology and investments, it's so applicable. It's such an interesting topic. I love this topic. But financial behavior, just as humans, the emotions that we all have, it's innate, it's within all of us, overtake our decision-making ability at times, right? Humans sometimes have tough times making decisions when there's just so much uncertainty and there's stress, and then emotions can overtake your rational decision-making and critical thinking, and you might make wrong decisions. Nobel Prizes have been awarded on this topic of behavioral finance. Things like the lottery effect, right? People buy lottery tickets, big payoffs, but incredibly small probabilities of actually happening and seeing that payoff. That's why you saw Bitcoin and marijuana stocks the last couple years have those incredible bubbles, really. That's behavioral finance in effect. But I think probably Victor is probably a good person to bring in now, given that he works with investors kind of on the financial planning side of this. So maybe Victor, I'll pass it over to you to delve into that topic.
Thank you, Niall, for taking the time. I just want to once again to thank you for the fact that you found the time to come out, and I know how busy you are. And thank you, Andrew, for the privilege of talking to your people.
My pleasure.
But I would say that I would probably be short, but I would say that from the working in the field for more than 15 years, I can say that I've seen these cycles. And what I can say that for the last century, as Niall said, that we have been in recessions. But I would say this is quite a unique one. It's out of the playbook, I would say. And specifically with the self-isolation, we never had that social distancing, for example, or many others that technically will come with losing the jobs and so on. But what's important to in this environment when we have this change and people are losing the confidence what's happening in the market, technically that leads to people feeling not so confident making decisions, and that usually takes into the fact that they are emotional driven and take not so good decisions. I would say poor decisions. My last experience what I had was 2008. And I'll give you a simple example. I had one of the CEO of a rental company. And I knew that at that time she didn't need that money. It was around the portfolio of around 600,000. And guess what? It wasn't a balanced approach. And she said, no, I'm going to sell. And it's interesting what Niall showed that last page. It's unbelievable how powerful he is, because when you go in the store and you see a 30-40% decline, guess what? Especially when I go with my wife at the Costco, and we stay 15-20 minutes just to try a sample, okay? And the same in the store. When you have a decline, and a substantial decline, and usually that decline of 30-35%, usually it doesn't happen so often. And usually for the last 100 years, it was around 7 times. And that is the time that people, they have to behave. We would expect to behave properly, but they do vice versa. And you saw what Niall showed in the chart. They do vice versa. How can we explain that? We say we so-called, we have financial behavior. We can talk about that, but that's very important. And for that reason, specifically, I asked because I know Andrew for many years, and I said, Andrew, how can I help your people? And yes, I'm an investment advisor, I'm a financial planner, I'm managing people's money, but I deal with people. And I say, if I can help someone, that's what the purpose for me to help the people. And I said, I have all these resources, and I have a Niall from RBC Global Asset Management. He has a reliable, objective information, because as you know, when you get in on the TV, you hear only bad news. And usually that bad news is yesterday date. And what I'm glad to what I saw today, Niall, you gave us a little bit of light on where it's happening. We've been through We're going to go again, and maybe probably we'll have one or two still in our lifetime. It's not the end of the world. It's different, but I would say that all the recessions are different. I never seen one that will be very similar, despite the fact that our economists are saying that it's close to 2 recessions what we had in the past, but will be a very unique one. Will be a very unique one. And what I want to mention here is that this presentation, I hope that you will take it and look into it, and I hope will help you if you need to make some decisions, investment decisions, or the decisions in investing in the real estate. Have a large picture. Look from the top and see, okay, as Andrew said, I'm looking for how many years, how the decisions will be made. And even if tomorrow happens something that you didn't, or it will not be in your benefit, how that will affect you. That's what we call in our world, we say how much risk tolerance you have, what's your investment objective, what's your time frame. It doesn't matter in what field you take this decision, be in the real estate, being in the investment, but it's very important to look at the long term, not just say, okay, on a daily trading, because usually the daily trading ends up that a lot of losses. And therefore you will have to pay for a long time to recover. But I also want to mention here that yes, indeed, it's very unique situation, and what we need to know is that only with the, I hope you have an advisor, and I hope you have an open communication. What's important this time, especially in this challenging time, you need to understand exactly where you're standing, what your portfolio is. Let's be in, as I said, in real estate or in the investment, and take your decisions very well calculated, because the market is moving very quickly. And Niall mentioned just last week we had in one day S&P 500 moved 7% up. It's very hard to time the market. That's why it's very important to have proper long term, but also to have your advisor with who you're working on. I'm glad that when I initially initiated that discussion with Andrew, I like the idea that he likes to work in a relationship with people. It's not on one sale is done. It's a teamwork, and that's very powerful, especially in this time. When you have a strong relationship and you are educating very well, you know what you have, what your strategies, that technically brings much better decisions. For the last 15 years, I was working with many companies, but why I specifically prefer, let's say, RBC Global Asset Management, because I had an example now, and Niall can discuss a little bit more. What we've done in November, December last year, I had the feeling that the market is moving and we have some concerns in the market. And what I've done, I addressed my people, I moved them in a more conservative way, in defensive way. And Niall is a guy that he knows everything what I do when I deal with the RBC Global Asset Management. And I had a meeting with him, I listened to him, and we keep just, everyone has its own position, just to understand. And he came when he came in I believe in February and in March, he came and said, Victor, you've done exactly what, as like you knew what's gonna happen. It's not about that, it's just more, if you have a good product, and I would say this, there is many products and many people, there's no wrong product. It's very important that your advisor, and let's say as Andrew is finding you a solution for that investment, it has to be the right product for the right person. So that's what is a good expertise of a professional. When the person, yes, he earns a fee from the service, but he finds the right, you as a customer or as a client, you know your job, you do your job and so on, and you can miss a lot of the important part when you make a decision, let's say, of the real estate or in the investment. And that's why you need to hire someone that reliable, a trustful person, but also to match your investment objective, to match your risk, to match your time frame, and also to adjust with those products and find the product that is the one that will stand by when it comes to time. And that's why I was glad when I used the RBC Global Asset Management products. My clients were very surprised when we were talking now and during this time, and they say, Victor, I thought that my portfolio will go much lower. I said, no, but that's why we put in this product. They are in defensive mode, and that specifically are designed for the recession. So that's what I would say. But you know, it's a lot of negativity on the market. A lot of, and yes, I know the government is doing a lot, but instead of putting people all together, instead of putting the positive that we're going to go through this, we've been through in our lives for many. Let's say if you take the 1 century, we had 2 wars, we had so many things. We'll go through this. What's important, once again, and I will finish with this, is just, once again, do your chores, do your job, find a good advisor, a trustful one, and stick with that and move forward, make the right decisions, not emotionally driven. Because it's so easy to get into this. I've seen, it's easy to say, but I've seen this, that, remember when I mentioned about that person, and technically she got on that in 2008, she got at that market was 20, it was a balanced approach, was minus 27. She got at that point sold that 600. So you imagine yourself, she was so much emotionally hurted that it took up to 2000, you will not believe, but 2017, she was staying in cash because it was so much emotionally affected. That was for me one of the lessons that I said, it's so important, paramount, to have an open discussion, communication with people. And before ending, I say, that's why what I said to Andrew, if I can help to bring the piece of wisdom, if I can bring some information to people, just for them to be informed, that's paramount for people. Because once they will be informed, knowing exactly what they're going to do, they will make the right decisions. That's what I would say from my side. And Andrew, please take over.
Thank you, Victor. I appreciate your wisdom. You're very, you're a wise man when it comes to this stuff. So again, if anyone wants to chat with Victor afterwards or have any questions, please reach out to me if you want his info, and I'd be happy to share it. He's a very patient man, and I respect him very much. So Neil, we have a few questions. Would you like to answer some of those right now, or would you like to just finish off and then we can answer them?
Yeah, I'm ready right now, because really, yeah, we kind of segued at a perfect time here, kind of finishing off with the investor experience. Yeah, so I think we're ready to go to some questions that people have been writing in.
Can you see the questions?
Yeah, I can see this chat box here. So maybe I'll start with this first one here. Okay. So the question is, hey Neil, any thought on the rhetoric in the media and investment blogs regarding the false bottom and also false bounce, where stock indices may drop to below the level we saw at the trough? Many comparisons have been made to prior bear markets where the same things happened. Lots of liquidity is pumped in. We see a short spike followed by another correction. So yeah, what the question here is from Alan. So thanks for the question, Alan. It's that the bear market bounce. That's what you're referring to there. People are definitely fearful on it. Like, that's the question right now. Is this just a quick rally before it goes down further? Now, there's lots of different views. RBC, we're a little more cautious. We don't think it's just going far back higher. This recovery is on. We don't think that's happening. Like Goldman Sachs, a big US investment bank, that's their call. Goldman Sachs officially thinks the recovery is back on. We're a little bit more cautious. We don't think it's that simple and easy because there is some negativity still outlying. However, it's not just liquidity that's pumped in that we think is giving us a little bit of optimism, but it's also the fiscal side of the stimulus relief package. So the central banks have done their monetary side, giving those bonds, like our chief bond manager saw, liquidity once again. So connecting buyers and sellers. It's this other unprecedented fiscal stimulus we're seeing right now, like 11 times larger than 2008. Like that's just an incredible amount, all very quickly. So that's why I would say that's giving a little bit of optimism. But that dollar cost averaging approach, like averaging into the market, whether it's every month a little bit at a time, that does two things. It counters against the fear people might have of the markets fall down further because you're only legging in slowly over time. But also people have the fear of missing out, right? If this rally does go much higher, like Goldman Sachs predicts, well, you counter against that too when you dollar cost in because you're slowly participating in that rally. So I hope that answers that first question there from Alan. I'll move on to the next one, I guess, Andre?
Yep, go ahead.
Yeah, so here's from Arlene. Yeah, best to use averaging. Yeah, that's exactly it, like 100%. That's what Stu Kedwell, our head of equities, recently said just last week on a call, is what he would be doing as a recommendation to investors right now, Arlene. And then I've got a question here from Christopher Ho. All the indicators like unemployment, COVID cases, corporate earnings that are missing resemble a down market. Yeah, and that's true. If so, how come the market has rallied so far up? I appreciate that market is forward-looking, but the bad economic news hasn't even come yet. And yeah, I would say that is really connected to your early point of the forward-looking. Like if people wait for all the good news to be present and clear, it's very obvious that things are going to go well, and it's we've completely passed this event. It's too late. Your chance to win that window to buy low and buy stocks that are on sale has passed by. They have moved before that happens. There's never going to be all the clear indicators ready to go. It's going to be a little bit more opaque at the time. So I would say that is what we'd kind of talk about when it's the bad that's still to come, the bad news. That's what we saw markets do in February and March. To your point, all the negative economic indicators you mentioned, like the unemployment, the growing COVID cases, that's what stocks were doing in February and March. Like I'll give you a bank example, like RBC, the company I work for, it fell down massively in February and March. Not because bad earnings had come out yet, they hadn't. Not because the dividend was cut, it hasn't been cut yet, but it's because in February and March, stock investors in the market believed those two things were going to happen. So stocks reacted back then for things that have yet to happen. I hope that answers your question there, Christopher, that yeah, there are so many bad news that are still to come, like you mentioned, but they're already being reflected. They're already priced in and baked into the price of a stock, like an RBC, for example, which was once over $100 and then fell to 80, 70, something like that. All that negativity that you just mentioned was all baked in and priced into that price of that stock.
Chris, if you want to chime in, feel free to unmute yourself and discuss if you have any more on that topic.
Yeah, just maybe as a follow-up to that, because looking at, I think, one of your charts with a lot of one of the charts with the bear market slide.
Oh, yeah.
There's a couple, like even on the 08 one, you could see the bounce and it comes back up and it keeps on going. I guess in 08, it took 1.4 years for a lot of that to get realized in. We're maybe like a month or two into COVID. Like, I guess, is there like a further sort of decline as people start realizing it's like, this is a lot worse than people think it is?
Yeah, I see your point. So if, let's say, the cases just grow and it gets away from the world, and this peaking we're seeing lately is a false peaking, yeah, I could see your point. The difference with 08, that was more structural as a financial crisis. Like it was a financial plumbing breaking down in our entire credit markets. So what happened in '08 was that the banking system was collapsing. The plumbing of the financial system, which is credit, that liquidity completely dried up. So it was more of a structural change there that was just so dire that it was going to take months and years and quarters to unravel and fix, because it was just really an entire system collapsing on itself. Today's recession is a government decree saying we are shutting down the economy and shutting down the ability to go out and purchase and go to retail on this day. And now what we're seeing in countries that have done it before us in Canada, they've opened and they've finished that government decree and they've turned on certain parts of the economy. Now, that's why we think it's going to be much shorter in duration here. And like what we're looking for here first in Canada is the schools. Like the schools are basically your first leg. We're going to leg back into this economy turning on again. And the schools make sense because the workforce can't go back to full-time jobs if they are still at home managing their children who are out of schools. So that has to be the first thing to happen. And then we can layer in other parts of the economy like manufacturing after that. That's what Spain's doing right now. So that's what we're really seeing as the kind of bellwether for when we get out of the other side of this. Our call at RBC is sometime in the month of June.
For what?
For the economy to start restarting again. So that's this government edict that's been a shutdown. That's was the cause of this recession to start unraveling itself. There'll still be pain that'll be felt from it afterwards for months, potentially a year. But certainly when we can start slowly reopening again is sometime in the month of June.
And also, if I can add on the question, why so the bad news still didn't come, or we don't see yet those unemployment, because the capital market usually has a tendency to take the data much faster than what we will hear as a simple people on the media and so on. So for example, the market is already pricing the fact that in the second quarter, the forecast is that, for example, in Canada, the unemployment might reach to 12–14%. So that's the data, a lot of data what is embedded in the capital market. So for example, another question, one of my clients asked, I have to renew my mortgage now and I have to go to the mortgage broker. What kind of rates should I expect? And I said, because I saw one of the questions, what's going to happen with the inflation? And I said, you might expect now the rates, despite the fact the prime rate now, it's the historical low at 0.25 of Bank of Canada. But you might see that the banks, commercial banks, will increase the rates, not so fast, but might increase. And that's what it happens to. So it's much more than just what you hear on the media. So that's what I would add to that discussion.
So then that can lead us to the next question from Angelo. Neil, if you want to answer that one.
Sure. So the next question here, is outlook on inflation. Yeah, so good question, actually. We're talking about this a lot right now. We see rates at these levels right now for the foreseeable future. Like interest rates are very low. We think they're going to stay like this for the near future. So that consider that a few quarters to a year or two. Just because demographics are so much older right now, so that keeps a lower a level on rates. Technology keeps a lower level on rates, just having more price competition. So there's going to be less inflation now than there was in the 70s when there was double-digit inflation. Eventually, however, we're printing a lot of money at the moment to fund all these fiscal stimulus and relief packages. You will see inflation pick up eventually because of that. It won't get to that incredible level of inflation we saw in the 70s. We're at record low, historical low today, below the 2% target. So certainly you could see inflation creep back up closer to 2 eventually, but not anytime soon.
Angelo, does that answer your question? If not, if you have any follow-ups to that, please feel free to chime in.
All good. all good.
Okay.
Thanks.
We can go on to the next question from Jane.
Okay, so Jane asked, with all the debt taken on by governments, what do you think will happen with standard of living, inflation? So yeah, definitely inflation, Jane, will pick up because of that debt. That's the printing of money. So that will slowly pick up from this incredibly low level here. And a 2-year recovery timeline. Yeah, that's basically it, Jane. 2-year recovery timeline to get back to the trajectory of where our economy was. So remember, it took 11 years after 2008 for us to get back to that trajectory. For this go-ahead time, it's about 2 years, we think, for the economy to get back to its full output, which means it's just its potential, where we were as a trajectory, as a pace of an economy.
So what do you think will happen, given that the governments around the world have taken on so much debt? That has to have some implication, like a 2% inflation rate sounds pretty low to me, because that's a real inflation rate. Are there not more significant, doesn't RBC see more significant consequences as a result of what is happening right now?
Yeah, inflation is actually a little bit lower than 2 in North America, and in Europe it's far lower than 2. So inflation's incredibly low, Jane. So to your point, there's so much debt being taken out right now. The only way that this debt is sustainable at the moment is just because inflation is so low. That's the only way. The benefit we have in North America, like I can talk to the Canadian experience and why we've actually got a little bit more positive view on our debt level, Jane, is that immigration. So Andre mentioned this immigration success story we actually have as Canadians. So last year in 2019, we had of the OECD countries, the 8 richest countries, the developed world, Canada had the highest immigration rate. So that is a great benefit to our economy because, as you know, aging demographics, and there's an aging workforce across the globe, you need to be able to replace that with new workers to have a growing economy. With people just having less children now than they did 40 years ago, immigration is going to support growing debt. Japan is the opposite of that. Japan has no immigration, low birth rates, inflation is incredibly low there, and any debt there is not going to be manageable with such a slowing population growth and just a slowing demographics. So for us, we think, yeah, debt's definitely a bit of a concern. The only thing that makes it sustainable is those low inflation rates today.
Okay, thank you.
Yeah, my pleasure. And then I've got a question here from Norman about outlook on exchange. Yeah. So yeah, good question, Norman. So a couple weeks ago, it hit 68 cents, the Canadian dollar, like just absolutely dropped in the worst of this damage because of oil dropping. We would say that's probably the low of where it's going to be this time around. It could go a little bit lower. It certainly won't go down to like 61 cents like we saw back in the 90s. But yeah, our forecast for where the dollar will be about a year from now, it's a little bit higher. We think Canadian dollar could rebound to like say 72 cents, but we don't think it's going to go incredibly low like it did the last period oil fell. So that's a currency. And then here's Christopher on market pricing and the probability of a second wave. Yeah, so I think, Chris, yeah, that's what you're kind of seeing this week. You saw some negative days yesterday in particular. Certain stocks in the retail sector, tourism sector, they are taking it the worst right now. Airlines especially, they are taking it the worst right now on a day like yesterday. Reflecting as any fear of a second wave, because you're right, Trump and the US states aren't as coordinated as many of the other countries we've talked about today. The states have more individual powers there. So it's less coordinated here, less coordinated there, because you have places like New York and California being incredibly stringent. Whereas there's other states that have an entirely different frame of mind, like the Dakotas as an example. So yeah, I hope that answers that question there. And then I have another one here. Yeah, will immigration slow? Yeah, well, Andre nailed it. Yeah, it definitely will in the near term. Yeah, absolutely. Immigration will slow this summer, absolutely. The next, until we really see open borders again, travel being more kind of common again, we'll definitely see immigration slow, but then we'll also have a bit of a pent-up demand. So you'll see a greater immigration flow after this kind of freezing period here. So I hope that answers your question there. And I've got one last one here from Norman. What would RBC's outlook be on commercial activity after bans are lifted? Would unemployment rates we are currently at increase as the businesses start to realize the lower demand for their products and services? Yeah, no, it's a good question, because it's almost right now you're seeing a lot of rethinking of businesses, like retail shops. They've seen an incredible drop in just the number of people visiting. Like Google Mobility, we can look at just the amount of trips that are being taken to office places, but in particular shopping malls, and they've dropped just incredible levels, more than 50%. However, that doesn't mean shopping has dropped 50%. Amazon has seen an incredible surge. Certain stores, when people do go shop at them, they buy far more in that one visit than they normally ever would have done in just visits prior to this virus. So shopping hasn't dropped by that amount. And that's going to be that rethinking. So yeah, great point. There's going to be less brick and mortar, which that means shops that you can physically go to and people servicing them. But there's going to be now a need for more services to facilitate the online retail segment. Yeah, there are going to be definitely a shifts of jobs, not necessarily a full change in the numbers, if that makes sense. And then I see another question here from Arlene. What's your outlook for the recovery of the travel industry? Yeah, that could be a little bit longer, Arlene. Bill Gates this week said that he thinks business trips are going to drop dramatically. Like there will still be business trips, like conferences. They make up such a large portion of the spending in the travel industry. That will probably be the longest to recover. People still going to visit relatives. Like I go to visit my European relatives in Ireland. I'm an Irish immigrant's son. So that will still occur, according to Bill Gates, and our chief economist would somewhat agree. But the business side of things, yeah, that will take a long recovery. So I think that's a sector that you'll see suffer longer throughout this. Other sectors that are going to do better, healthcare and technology on the flip side of things. Healthcare for obvious reasons. There's some incredible pharmaceutical companies that are on the leading edge of vaccine development. Roche Holdings in Switzerland is one of them. And then technology, like whether it's Zoom, that platform that Andre's using to host this, growing demand for that. But also just any technology company, whether it's an Amazon or a Google, have an incredible demand. They are also benefiting at rates being so low, because with rates being that low for giant companies like that, they can borrow, they can invest in the technology, whether it's 5G or just their workforce or just innovation. They can compound their returns at higher levels. So there will be some loser sectors that will have a tough time, like entertainment and travel and tourism. On the flip side, life sciences, healthcare, technology, those will be winners.
Okay.
So those are all the formal questions here, Andre.
Yeah. So again, if there isn't any more questions, I'll just wait another few moments to see if there's anyone else has a question. But I would like to thank yourself, Neil and Victor, for speaking, for sharing your knowledge, and I really do appreciate it. And for all you attendees who've come on here live, I thank you. You know, although we might be at home, I know that we still have a lot to do. We all have families. We all have our own chores, our own concerns, and you know, I never thought it would be this challenging to just be sitting on a couch or a chair and live life this way. But everyone has their own concerns. Everyone has their own worries and anxieties, and I'm definitely one of them who has them as well. And I'm at home trying to take care of my family, and I'm also worrying about how my clients are doing as well. So I'm sure everyone else is in the similar boats where you have your own concerns. So I want to thank you personally for sitting and listening to us and watching us, and I hope it was valuable. And if you stay tuned, I will post this video on my website and on YouTube, and it's also on Facebook for any of you who want to watch it or share it. Thank you, Chris. Yes, I appreciate it very much. Again, if you guys want to say any last words, I'm opening up to you guys.
Yeah, I'd just like to also thank everyone for the presentation today. Andre, for you putting it on, and for Neil and Victor for sharing the insights. Thanks so much.
Our pleasure. Thanks for your time, Jane.
You're welcome.
Thank you, guys. And all right, that's a wrap, guys. Thank you, and enjoy the rest of your evening. And I will be in touch soon again.
Take care. Bye-bye.
Bye, everybody.
Bye, guys. Thank you. Thank you, Andre.